All right, here we go. Number 3. These are going to start out the same. The first couple minutes, I got to keep burying this saying into everybody's head. When anger is the emotion that gets you confident, you're in trouble. How often does it happen where you get mad, you get mad, you get mad, and the next thing you do is going to be bad? Also, if you don't know much about me, there I am at the bottom. I started my career at the CME Group in 1991, got back there in 96, became a Board of Trade member, which is what you need to be when you trade in the pit or on the floor in the pit. I was ready to quit, so I couldn't make any money, and then I got hired by one of the bigger Chicago prop firms, International Trading Group, and without that, and they were pioneers actually in prop trading, but without that, I wouldn't have made it on the floor. The transition, I went from making no money to more money than my dad, and I was home by 11 o'clock in the morning. I was just telling the story, the start of my career. We only traded European futures, Eurex. They were pretty much closed at 10:30 Central a.m. We'd get to the office at 7. We were done by 10:30. We'd have lunch and go home. They had a kitchen, so we were able to eat there. But I learned the collaboration, being around other people, kind of just backed into education. And so that's where this Edge Trading Group came from and everything else. So what helped me will help others, and that's putting yourself around good people. Getting into the why, I said in this picture, I'm going to show it to you every time I do a webinar. It's a picture of my family, me on the left, my dad on the right. He said, if you know how, you'll have a job. If you know why, you'll be the boss. Jim, remind me, I'll tell you that story, why they hired me. If you know how, you have a job. If you know why, you'll be the boss. And that's what this checklist is to start the year, the why. So the first webinar we did, 2 things you must look at on a chart, check. Our last one, number 2, order flow, real-time stop hunting, and kind of understanding where other people are trapped, check. Today we're going to talk about market correlations or market relationships. And what I say is learn what no one else is teaching. 2 reasons why I say that. Number 1, because people have come to me after they learned it and said nobody else is teaching this. And then number 2, I actually did a Google search, and I encourage you to do one as well. Market correlations for day traders, market relationship, and you'll see nobody's talking about it. So that's what we're going to talk about today. Tomorrow night, 7 p.m. Central, we're going to do trade review Sunday night. Those watching this in the future, again, all the videos will probably be up on YouTube, so the dates and times don't matter. And then on Monday morning, 11 Central, we're going to pull it all together. So right now we're on number 3. I also said this in front of the other 2 webinars. I want to make what's basic to me basic to you. I want to make what's basic to me basic to you, because when you learn the right basic skill set, it's also the advance. I don't know if that's true in every industry. It probably is. I know it's true in this business for sure. So what we're going to talk about through these market relationships, and we're going to go to charts at the end like I do on all these webinars. We're going to talk about taking a consumer skill everybody has and applying it to trading. It's silly why you wouldn't. I'm going to tell you a story on how I shouldn't take for granted what little people know. And I'm not saying that in a condescending way, because I was guilty as charged in my career, but a story about Dan. Dan might even be here today. Dan, are you here? We'll talk about same way markets or opposite. We'll talk about highs versus highs, lows versus lows, to compare and contrast and be able to find strength and weakness through this technique. We'll talk about what markets are important to the market you're trading. If you're not trading ES or you're trading some other market, ask me. I give you an idea of what a good complex or good correlations are. And then we'll talk about comparing everything, whether they're market profile levels or support resistance. It's not just price and highs and lows, but you can compare and should compare through your analysis multiple things across multiple markets. Now, with this being said, you can't compare the S&P E-minis to palladium futures, right? It's not really going to be a strong correlation, but there's different correlations that break down and come in. So while I won't cover in great detail every single, driver and what makes this more important, that's why it's really an important kind of part of your journey, is to stay connected with people that are watching and looking at the right stuff, because then someone says to you in that environment, hey, look at the bonds or look at the Russell, or, if nobody's watching that, or if you're just by yourself, you're going to miss what's driving the market and will give you a head start. So let's get going here. Story about Dan. Dan doesn't look like that, nor does he dress like that, but that's what we're going to make him look like for today's story. I'm going to tell you about what Dan does for a living and what he did do for a living because it's relevant to this story, but I'll tell you that at the end. A couple years ago, and stick with me a second, but a couple years now, about 3 or 4 years ago now, Dan called me up or got a hold of me through my room and asked to talk. And, I make myself available to people who want to talk. I go by the notion that important people are available, or important people are important because they're available. So Dan asked me to talk, and we're on the phone, and he says to me, he goes, Anthony, I'm trading 30. I asked him a couple questions. I says, Dan, what are you trading? And he says, 30-year bonds. And I said, 30-year bonds. Okay. How long have you been trading? I think you'd been trading for a year or two. And, I said, well, what do you watch when you trade these 30-year bonds? Now, remember, this a few years ago. This is his first introduction to me. He says, 30-year bonds. I says, you watch the 30-year bonds? Yeah. He said, sometimes I look at the 10-year, but really, I don't know for what reason. But yeah, I trade the 30-year bonds. I look at the 30-year bonds. I said, do you look at the S&Ps, the S&P minis? And he kind of said, I could tell the tone of his voice. He says, no, I look at the 30-year bonds. That's like he's almost telling me, that's what I told you I traded. So, yeah, look at the 30-year bonds. 30-year. And so I go to him, I go, well, the reason why I'm telling you this is because when you trade the 30-year bonds or treasuries like that, they tend to go up when stocks go down. And sometimes the ES, the stock index, leads the bond, sometimes vice versa. But it's important to look at when there's opposite correlation, that there's fear in the market, you get a move lower in stocks, it drives the bonds higher, maybe at the same time, maybe there's a lag. But it's important to compare and contrast these markets even on charts, if not in real time, tick for tick. And I could tell that he wasn't buying it. And years later, I remember asking him about this conversation. And he says to me, I go, what did you think when I told you that on the call? He says, well, he goes, I went home that day and pulled up the charts and said, holy SHIT is right. He says, because when you told me that on the phone, I said, this guy's full of crap. He used another word. But the reason why I bring up his name is because, and not because of any other reason that most people might think this way, and I think they do, but the number one reason why is because Dan is and was a real estate appraiser. Now think about that for a second. Here's a guy for 20 years, compares and contrasts houses to find value. And yet it didn't make sense why he would look at another market to do the same thing, value price. And it's not his fault. I mean, for 4 years, he's been successful now. And I'm not saying taking credit for it. What I'm saying is not a dumb guy, smart guy and everything else, but it didn't dawn on him, not just that markets would relate, but how to watch them. And from that moment, I took it for granted that everybody understood that you got to compare and contrast. And then I thought back to myself and I thought, now, wait a second, even though I came from the pit and even though I was looking at different markets to quote the market I was clerking for, when I got hired into the pit, there were a bunch of guys opposite of me standing in the pit. Let's pretend these are their heads. And all their eyes were focused, their heads were turned focused in one direction, up. All right. And it never dawned on me that we were trading Dow futures in this pit. It never dawned on me they were looking up at what the S&P E-minis were doing at the CME. The Dow futures were at the Chicago Board of Trade. So they were looking at uptick, downticks in the S&P minis because they're going to leave the Dow around. And I had been in the business for a few years, and it didn't dawn on me that's what they were looking for. And yet I had my membership. I was in the pit. I was able to trade. And I was so fearful because it was just random to me. And it didn't dawn on me as to what they were looking for, even though I had all that experience. So it's important to understand. It's important to understand that don't take this for granted. If you know a little bit about it, maybe after today, I think you'll know a little bit more and then go further from there. But what's most important is that don't take for granted that everybody knows this, because most don't. Most will never put themselves in front of this kind of education. So that's the story of Dan. Why would this matter? Here's another example that's pretty clear. If Dan, well, that's not going to be Dan forever, but if this guy's going out and that's you to buy a car, and the car dealership you go to tells you the price of this car is $50,000, how do you know if it's cheap or expensive? You got to compare it to other salesmen and other dealerships to find value. You do it. We've all done it when we buy cars, plane tickets, houses, like in the real estate appraiser example. So why wouldn't you do it when you trade futures or trade Forex or trade stocks? It's silly to trade Apple and not know where the tech sector is or know where the FANG stocks are, or know where the NASDAQ might be, right? So we do it our entire life to buy and sell anything. And then you get introduced to this business and you don't do it. It's like, well, what the hell's the sense? And it's not your fault because I'm in the same boat years ago. When I started in a prop firm, I had a good foundation of how markets worked. So it was easy for me to click and say, hey, wait a second. You're trading the Euro stocks. I know what the S&Ps are doing. Euro stocks is a stock index in Europe. You're trading the DAX, which is a German stock index. You got to know what the U.S. stock markets are doing, especially back then. So they relate for obvious reasons. Let me just draw and use this space to sketch a little bit and give you guys a sense of what we're going to look at on real charts to make it easier to understand, I think, with these illustrations. When we talk about, first of all, you got to know with cars, it's easy. You're looking to buy a Mercedes E-Class, then you compare it to Mercedes E-Class at a different dealership. Or if you're looking at the same kind of make in the same price range in BMW. So you could compare apples to oranges. It doesn't have to be exactly. In fact, you don't want it to be exactly the same always. So if this car is $50,000 and this car is $50,000, you haven't really found anything. Maybe you found it's priced accurately. You got to look for an outlier. You got to look for something that says, you know what, same car, this guy wants $45,000. Probably not going to be that much less, but you get the example. Now all of a sudden, you've got some perspective. Also, remember this. This applies so directly into trading, it's ridiculous. You got all the information. You got all your game plan to negotiate with the salesman and the general manager, and you know your numbers. Then you go in there, and emotion takes over. Maybe your spouse is with you. Maybe they say something to knock you off your game and your game plan. And all of a sudden, you didn't do as good of a job getting it closer to 45, and you end up paying 52 or 50. The point is that when emotion's involved, it throws a lot of your homework and objectivity out. And how often does that happen in trading? How often does that happen when your game plan is, I'm bullish, I'm going to play it from the long side? You look up, your first trade short. And it's like one thing not to listen to what you want to do. It's another thing to do the opposite. And I'm guilty of sometimes, right? I'm not here saying I'm perfect. I'm far from it. I just know that it happens because I've done it. I'm bullish coming in. It was the right opinion. And look, I'm up and I'm short. It's like, come on. You don't have to play from the long side, but don't get short right away. At least be consistent. Even if it goes down, who cares? Do what you say, and all of a sudden you build momentum. It's like, hey, first of the year right now when we're doing this live session. If you say you're going to go work out, and well, just do it. You'll be surprised at how you can build momentum quick. And here's the other thing. When you don't do what you say you're going to do, a little piece of you goes away. Even if you have a good excuse not to do it. Every time you don't do what you say you're going to do, whether it's in a trade, whether it's going to exercise, whether it's taking your wife to dinner, a little piece of you goes away. So just be consistent, even if it doesn't work out. Do it. Now, back to these relationships in the form of markets here. When you have cars, it's easy to know what you can compare it to. Plane tickets, you go to Orbitz or Travelocity, they compare United to Delta to American Airlines and tell you where you're going. Here's what's cheap, here's what's expensive. Now with equity futures and bond futures and Forex, it's not as clear as to maybe what to look at. So we're going to clean that up today. And that is, it's obvious that a complex might be for the S&P E-minis, the ES would certainly be the NASDAQ. Why? They're both equity markets. Might be the Dow because it's an equity market. Also the Russell, something that a lot of people might not look at. Small cap, but these are all equity markets. It's obvious that when the ES looks like this, the NASDAQ might look like that. The Dow might look like that. The Russell might look like that. Not exactly like that, but similar, correct? If one's bullish, they're most likely all bullish. There's no clue when everything looks the same. If I'm playing poker and I can't find any kind of change in the disposition or activity of the guys, then you're not finding the clues, right? If the detective's interviewing the suspect, can't really find something he's doing different, he might think he's honest or can't find a clue. Clue is something changes, something's different. What should I watch? How can I find value? Well, you got to compare it to something else. So let's say in these 3 or 4 examples of the charts looking the same, I can't find anything on that. But let's just say the ES goes up, comes down, re-rallies, and is up here. The NASDAQ goes up. So this high right here is going to be this high right here. And it tries to go up, but it's down here. This second dot is this second dot. Now, I'm just illustrating this, obviously, far from perfect or accurate. But do you see the difference? Do you see how the ES went through this high right there and how the NASDAQ could not get through that same corresponding swing high or day high, whatever high it is? Do you see that? So all you know that the NASDAQ is weak and the S&Ps are strong. Now, the question might arise, well, what do I do? Buy the strong one, sell the weak one? Should I get short this guy because it's expensive? Should I get long this guy because it's cheap? The key is, first off, is to notice that there's something that's changed. All right. Notice that there's a dealership selling a car for $45,000 down the street. Notice that you might be able to get this 50,000 number down if it's buying and selling cars. But the first thing is just recognition. So in my opinion, what I tell people is, if you're bullish the S&Ps, the weak one's the thorn in your side. If you're bullish or long the S&Ps, man, if you can get this thing to rally, you probably got a great trade in here. But you need this thing to go up because it's a pain in your rear end right now. If you're bearish the S&Ps, all of a sudden, this is your maybe slap yourself in the face. I think if I had the perfect indicator to invent, it would be a hand that came out of your monitor and slapped you in the face. And this would be a case. It would just, not hard, just give you a little tap to say, hey, pay attention. NASDAQ's weak, not making higher highs. This is your moment to sell resistance. This is your moment to execute your bearish trade that you always miss. It's the moment to sell PLC and the market profile and all the great studies you do from the hundreds of books you read. Again, correlation to say something's changed. Generally, look over here, they look similar like that. But for some reason, the NASDAQ stopping there. Could the NASDAQ catch up and make higher highs? Of course they can. Of course they can. But you're getting a sense of, hey, what's weak, what's strong. If you're still looking to get long the ES, a lot of times this keeps me from losers, right? It keeps me from buying an outstretched rubber band up here because I see something's lagging that's compared to it. And I'm comparing in this example the ES to the NASDAQ. Could be the ES to the Russell, ES to the Dow. It could be like, hey, listen, the Russell is really weak because, let me clean up some of these drawings. The Russell is charting like this, and all the rest of them aren't going up, but they're certainly not going down. They're like that. They're going sideways, and the Russell's getting heat or getting beat on their lows. And there are guys that do really well playing the other equities from the short side, really feeling the Russell is going to be a leader. And a lot of times it is for the day, you know, and it keeps you out of maybe some poor long trades and gets you in the right side of the market for understanding just a compare contrast technique. And you think about all the effort. How many people in here, I asked this question before I started, how many people in here are market profile or volume profile students, whether you're proficient or not, you're studying or studied profile techniques? All right. And I would probably get a lot. I'm getting a lot of people that do it more so than not. And there's nothing wrong with it. There's nothing wrong with profiling. And I think it's a healthy tool. The weakness in profiling is while it tells you where the market might go, it doesn't tell you when. And you could be long right here, and the market is just doing this against you, this against you, this against you. You get out, and then it goes up. It doesn't give you a tight range to enter, or timing, I think is a better word. And while it has its strengths, that's one of its weaknesses. And everybody I tell people that agree that the weakness is the when moments. So you could utilize correlations with saying that, hey, the Russell's weak. I'm coming in to the bottom of value on a particular S&P market, and that's somewhere I like to sell. Now this gives me more confidence, especially when you get good to see the Russell spike lower quickly. You could grab something quick and start to find better locations. Now, one thing I want to say as part of this webinar and the previous webinars and future webinars is that no matter what your time frame is, all this stuff is relevant. Doesn't matter if you're going to own that car for 2 seconds or 2 years or 20 years. You got to buy it in real time. You got to value price in real time. The difference when using the skill sets that I teach is that when you trade shorter time frame, your decisions and your areas are narrower. When you trade a larger time frame, you have a wider area of where you're going to fight for your location and for your trade. Because when you have a longer time frame, you're going to want bigger rewards. And when you want bigger rewards, you got to take bigger risk. There's no way around it. When you're looking at smaller winners, and I don't mean scalping, but I just mean smaller winners relative to longer time frame traders, you got to be a little bit better at location, because if you're making less, you better be risking less. A lot of people get this upside down where they're risking obviously a lot more than they're taking out. And they're a short-term trader when they have a winning trade, and they're a long-term trader when they have a losing trade. And think about that for a second. When they have a winning trade, they're a shorter time frame trader. When they have a losing trade, they fall in love with it, and they're a longer time frame trader. So you want to avoid that. I didn't plan on covering this, but the reason for that, why you cut your winners and let your losers run, it's supposed to be the opposite. People always say, the guy that wrote the book, let your winners run and cut your losers short. That's great. But, we're built to do the opposite. Why are we built to do the opposite? Because for some reason, we hate being wrong. Whether it's about an argument on what baseball team is better in a bar, or being long and the market's going down in a trade. As soon as you exit a losing trade, you just admitted to the world you're wrong. And you're not wrong until you get out. So you hold on to, I'm not wrong if I don't get out. So maybe you add to it, or you just hold on to it. You're not wrong until you get out. Price will be the first thing to tell you that you're wrong. On the flip side, we love being right. Love it. Just think of in third grade when you knew the answer to the teacher's question. Your world was that classroom, and you knew the answer you wanted to be called on. We love being right. And so when we get a winner, we're not right until we get out. So we tend to get anxious and get out. So the psychology behind letting your winners run and cut your losers short is just opposite to how we're wired. So you better understand you got a lot of working to do. Not working to do. A lot of training is a better word to do, because we're not wired. It's not a very good compatible technique. Going back to, I just compared two markets on their highs. Let me show you this again. What's different? This is the example I gave. Well, this one's probably a little weaker. And just keep it simple. If you notice, a lot of the stuff that I teach are, why didn't I think of that kind of ideas? And I'm not saying this because I think that. I'm saying this because for the last 7 years of training guys, that's what I'm told. Why didn't I think of that? Techniques are what you want to continue to learn. The other key to comparing and contrasting would be on lows. I'm going to show you a couple charts on this. When you look at a low, the market rallies like crazy off that low. And we love to be long and play rejection, pick a bottom. Well, what could get you to pick a bottom better? How about if at the same time, when I got to draw this a little bit better, that's a lower low. At the same time, let me redraw it. It's like one's W is crooked, this one's crooked the different way. We love to be bottom feeders and get long down in here. Do you see the divergence that I like to call it on the lows? This NASDAQ, let's call it market right here, is stronger because it didn't make a lower low in here. The two circles I just made are done at the same time. NASDAQ did not breach this low, but the ES did, and it did in there. So this time, this guy is weaker and this guy is stronger. Again, do you get long the strong one, short the weak one? This is supposed to open your eyes a little wider to say that if you got support down in here, you're looking to buy it for another reason, this could be your kick in the rear end qualifier, the NASDAQ showing strength. As you get better at watching markets in real time, more than one, first of all, you notice that the NASDAQ is not making lows and is a little stronger. Then you get but you're anticipating an uptick. Then you could jump in and grab something in the ES. And now you have an expectation for it to go up ASAP. And when you have an expectation that's based on stuff like this, you also have better timing, because if it doesn't do what you think it should do, you can get out. A lot of people have indecision as to when to get out. Well, if a lot of your important stuff lined up and it didn't go up and the NASDAQ keeps going up and this son of a gun ain't going up, get the hell out. That's an important part of comparing markets as well. Keeping you confident or not confident when you're in a trade. If you think that the market is strong and you're long, obviously you think the market's going to go up if you're long, and the NASDAQ is strong and going up, and the Dow is upticking, and the Russell's upticking, and your trade is just hanging around your entry, I'm getting the hell out, because as soon as these markets turn and go lower, this thing is gone. It's almost like someone standing on this market saying, nope, and they're collecting a lot of people long, stuck, long, stuck, long, stuck, long, stuck. Punch in the face story I told in the previous webinar. And so all those longs, what happens? When you're long, you're a seller. If there's too many longs, too many sellers, and then these ancillary markets are getting hit, look out below. So when you're accurately comparing and contrasting markets in real time, and they're the right markets, and you pull off, hey, wait a second, that's why you'll hear me in the trading room talk about be careful long, because we should be higher. Well, why should we be higher? Because of a gut feeling? No, because the other ancillary markets are strong. And it's just a probability. It allows you to be consistent. It really does. You're trying to set yourself up as I'm going through this checklist for 2020 and to start any year out correctly. It's all about how could you put yourself in a position to go to the health club and work out 6 days a week? How could you make it easier? Have the health club in your house? Maybe. Play video games as you're on the treadmill? Maybe. What makes it easier to work out? And the same thing with trading. What makes it easier to make good decisions in a very subjective and emotional environment? And it's, finding the stuff making decisions for you instead of your emotions. Because if you let your emotions make your decisions, it goes back to the first line of this webinar. When anger is the emotion that makes your decisions for you, you're in trouble. So to keep yourself more consistent, you're now putting yourself in an environment of watching the right stuff. And in our Monday event, putting it all together, we'll take these circles and kind of tie them together and give you better ideas on how, when all these circles overlap in your skill set, to be able to make better trades and not feel like they're a good guess when you're right. Now, so I just compared on the highs. One market goes up, this one doesn't. I compared on the lows. This market went through it. This market didn't. All right. It should be simple enough to understand that. Recognize it in real time. That'll take you time, but at least you're looking at the right stuff. At least you're together, especially if you're with a better group, paying attention to what's right. Like these webinars, I'm not here to promote anything yet. I'll do that later, probably in a week or so, if you guys are interested. But I'm going to tell you that the best trading room that you want to be part of, I don't claim to have the best one. I claim to have one that meets the expectations if they're set properly, and that is keep my eyes and ears on stuff that matters, and I'm listening to a guy that's going to catch something that I might have missed. Whether it's a correlated market that's doing something I might have missed, whether it's a news event that I might have missed, whether it's a big move in oil, something. That's the room you want to be involved in. not just the guy squawking out news because he's just giving you something straight. How does that news affect the market you're trading? This moves me into something in market relationships I added, and that is the relationship. When I say I added, I wasn't going to talk about it today, but it's important to talk about it. I added the correlations that I teach all the time, and people in my room are more than proficient enough because you have to be. And that is the relationship to the price of your market to a news event. And Joe, I'll answer your question at the end. So stay with me. What is the driver? What was the driver last year? If you're watching this at some point in the future, what was the driver for most of 2019? U.S.-China trade. Everybody knows that. If you don't, you should. That was whether it was a Trump tweet, whether it was a headline out of China, whether it was a headline out of Kudlow or an interview on CNBC. There was a lot of opportunity, a lot of market movement based on that story for the better part of a year. Sometimes you come into a year or come into a period where you don't know what the driver is going to be until it's a driver. 2 weeks ago, you couldn't have predicted Iran was going to be a driver like it has been Thursday, Friday of last week, including yesterday. What happens with Iran? Well, markets don't like, and I'm going to cover this because it's important. Stock markets do not like uncertainty. They would rather know the details of something bad, they could actually rally on that, than no details on something that might end up being good. They want certainty, and uncertainty has always spooked stock prices, always. All right, so when there is confrontation, when there is uncertainty as to what escalation there could be, oil prices, because it's Middle East geopolitically, will go up. Stock prices are spooked because they don't know what's next, and they will go down. Number one, because the precursor of war, but most importantly, the I don't know what's next. So stocks go down, and this introduces the relationship to bonds. I talked about on the agenda page, markets that correlate the same is easy to understand, right? NASDAQ's going to correlate similar to the S&P because they're both stock indexes, all right? But why do stocks and bonds correlate? Like I told the story with Dan, they're opposite. And they're opposite because of the word asset allocation. Asset allocation, not to sound smart, but to understand where people put $1 billion. You can't hide $1 billion in your mattress. I'd like to try, but you're not going to be able to do it. So hedge funds that are looking to reduce the risk in stocks, sell stocks, they have to do something with them. They put them in bonds, something safe, U.S. Treasuries. So the opposite effect, stocks go down, bonds go up, makes sense now. In drivers that create fear, this relationship is more dominant and is more clear to understand if you're looking for it and understand it. If you have no idea about it, obviously you're not going to see what you're not looking for. Really important to see the relationship between stocks and bonds. And I'm going to show you a chart from yesterday where it happened again and again and again. One goes up, one goes down. And the same thing when stocks go down, bonds go up. But let me erase some of these. When stocks re-rally and maybe the fear goes away for whatever reason, bonds come down. Now, I'm not selling my stocks and buying bonds. I'm selling stocks because I see bonds go up or I see that relationship might happen. And I'm not actually part of that asset allocation. I'm not moving $1 billion around, but I know the market is trying to price in the bigger investors, the bigger hedge funds, the bigger money moving from one sector, one space to another, one instrument to another. Does that make sense? Why? And that's essentially called asset allocation. You're allocating your assets from one and parking them into another. And for the reason, in this case, because of the uncertainty and the fear that's just come into the market the last few days. And if you're watching this video in the future, it's when the U.S. and Iran are in this confrontation where they're kind of going back and forth. And you got to understand the story. And you don't understand these stories based on your political ideology, based on your based on what you agree with. You understand these as a trader to sharpen your anticipation skills as to what the next headline could be and what the hell does it mean to the market you're trading. I'll say it again. You understand these events as to how it's going to affect the price of the market you're trading, not whether you agree or disagree. All right. There's another room that I have where there's guys that actually talk and listen to each other. All right. And I try to tell them, keep politics out of it as much as possible. But once in a while, everyone's human. It comes in. Anybody that might complain about a political ideology that someone might say you don't agree with, I tell them, hey, that's good. When you're in a trading room, when you're in an environment about trading, one of the skill sets, and remember this, one of the skill sets is to have a callous and not care about someone who disagrees with you. That's part of your training to be a good trader. Because think about the price of the market doesn't agree with you and your losers, correct? When you're long and the market goes down, it's not agreeing with your opinion. Are you going to get really worked up and mad about that? Guess what? Too bad. That's part of the business. So in life, people don't agree with your political ideology. Who cares? You got to roll off you. You got to get good at not getting offended. You got to get good at being wrong or not worrying about whether or not you're wrong because you disagree. You got to get good at disagreeable moments. And if they bother you, then this business is going to be tougher because the market's price is always disagreeing with your thought. So keep that in mind when you listen to other people. Don't let that, whether it's inside a trading environment or outside in your private life. When you're trading, and most of you guys are, or you wouldn't be here, remember one thing. When you're out in a private life, my life, I think, is so much better because I take all my trading skills and I adapt them into trading everything. Everything I do is trading, whether it's emotions, if it's humor, if it's ideas, if it's fists. You're always trading something with someone else. And I feel I got a strong marriage because it's easy for me to admit that I'm wrong pretty quickly. So we don't go on days not speaking. Boom, I'm wrong. Sorry, I'm wrong. And I'm genuine about it. But I understand that being wrong doesn't matter. It's always about solutions. So the solution to a losing trade is get out, get back in, or do what I said I was going to do, or know where I'm getting out before I get in. If I don't do that, I'm wrong. The guy in the mirror is always the one wrong, always. So this business is so applicable to everything that you do in life. I just had this happen to me. Once in a while it happens, and I thought of what I say. I was at an intersection, a four-way stop. 3 people were stopped. You know what my premise is? I'm a decision maker. Tie goes to Tony. So I'm not sitting there looking at everybody. I'm going. And no one's going to hit me. They might give me the finger, but hey, you waited. I waited. This guy waited. What are we going to do? Sit here and hold hands? Tie goes to me. You got to make decisions. What's the risk? He's not going to hit me. The risk is he gives me the finger. I've been given the finger before. All right, let's go to live charts. Not live charts, but charts. It's Saturday, so we don't have live charts. Anybody got questions about any of this first? Then we'll go to some charts. There's a good crowd here today. I'm impressed with the attendance. You guys, a lot of familiar names, which is cool. All right, let's go to some live charts. Not live charts because it's a Saturday. What do I have to do to get this off? Oh, I know. Let's close this. And don't get all excited about these dials. I'm not going to talk much about these dials, but they do give you a sense of compare contrast. Don't ask me about them yet because they're not something that I have available yet. Let's go to the NASDAQ and the ES. And there's a lot of movement because of the driver and the relationship between the news event, the headline, Iran in the U.S., and that geopolitical conflict surfacing. So take a look. The ES is here on the right. Omar, give me a second. I'll get back to it. Well, you know what? Let me answer this now. This is a good question. What are the benchmarks that I'm using to compare? Highs and lows, number one. And, versus, you know what I mean? Like in the example, there's a low and there's a low. They both were made at the same time. Like in the example I'm going to give now, those are the most important. Those are the biggest benchmarks that I use to compare. The close or opens, not as much. VWAPs, not as much. But what I'm going to talk about briefly is those that are proficient at profile don't just profile one market anymore. Profile ancillaries and see when both are outside of value, or if both are outside of value. Start applying the strategy you use in profile to both. And so you can't compare it to VWAP. I don't, but that doesn't mean it's bad. It's just so many things I want to look at or can look at. Highs and lows are first. And the other thing is consolidation, breaking out of a consolidation range. And I'll show that example. So here, on the left is the NQ, the NASDAQ. And on the right is the S&P, the ES. Just focus on the lows down in here and down in here. All right. Remember what I showed on just the drawing? I'll put it up here again. Let's do a shade here. This low here was made at the same time as this low. All of a sudden, the market in the ES, now this is overnight, but the market was moving overnight because of what's been going on. So the market runs up in the NASDAQ and tries to come back down in here. Let's see what the ES does. The ES will run up a little bit right here. Let's see it roll back south as I advance these charts. You see how the S&Ps went through? Let me draw this shade better. There we go. Do you see how the S&Ps right in here went through that yellow shade, and the NASDAQ is still hanging above its yellow shade or above its lows? Now, does that get you long? Yeah, it could. Especially you have potential support in the ES. It could be your helpful qualifier. You have support in the NASDAQ. So like I said on the agenda page, it's not just comparing highs and lows. It could be comparing support to support for whatever and however you get your support or resistance. In Omar's question, VWAPs or pivots. Yes, for me, it's edge zones, highs, lows, edge zones, and consolidation. So you got potential support here in the NASDAQ, potential support here in the ES, and a divergence. One is showing, hey, we're going to make lower lows, and the other one isn't. And again, does that mean you're going to get this rally out of the hole each time? No, of course not. But it does stack probabilities. And now you are using the same damn thing you use as a consumer to value price. Nobody would argue. There's a lot of people that have a good argument when they talk to people who are teaching, when they're teaching profile or when they're teaching Fibonacci or Elliott waves. They could have arguments as to why they don't think that works and that's arbitrary and everything else. Nobody would debate that comparing two like markets are not the right way to find good, accurate value in those markets and in those prices. Because if that's the case, then go bring a Fibonacci chart into the car dealership to negotiate price next time, right? Don't do it when you buy a plane ticket. Go to Travelocity and pay for a ticket $800 for United when American Airlines was $300. How you find value? Does everybody get the higher low here and the lower low here? You wouldn't have been able to know maybe the NASDAQ is getting strong unless you could compare it to something else that was weaker. Make sense? Now, this market got weak and stayed weak. Not stayed weak, but got volatile. Anytime there's a new driver introduced to the market, there's volatility. Anytime there's volatility, there's more volume. Anytime there's more volume, there's wider ranges. Anytime there's wider ranges, there's more risk. The more price moves, the more risk you're taking, period. So what I tell people is if your biggest size is a one lot, you got to really be careful because you can't cut your size. Go to the micro maybe. But if you trade 3 lots in the S&P, go to 2 lots when it's volatile because the price of poker has gone up. You're not going to be able to get out where you normally get out. And so Friday and maybe in the next week, depending on how this story unfolds, the price of poker has gone up. So that's the comparison on the lows. Let me bring in the bonds. And I did the background in red to show you it's opposite. I actually didn't do that. It's something sticky with this indicator that's on there. So I made that up. But this is the bonds. All right. And you can see the bond price rallies quite a bit in here. Correct? Now, let me back up this guy to right there. Now, take a look at a couple things. And we talked about this in the very first webinar. We talked about consolidation boxes. Take a look at that one and take a look at this one. Two markets that are acting opposite because of the Iran story over the last 2 days. When you see there's potential to break out the top of the box, and at the same time they can move through the bottom of a box in an inverted relationship, it gives you more confidence to play the breakout or get the hell out of the way if you're looking to buy it. The bonds rally first. You know there's some downside because there's the bottom of this consolidation. Now you're using all this stuff and starting to put it together. Let me draw it. Let's go back here a second. Let's show the box before you know what's happening. And again, everything looks easier after the chart's drawn out. I'm the first one to admit it. But that's why, again, a real-time trading room is the individual giving opinions in real time, showing you why, giving these examples. And when they're wrong, I'm not wrong for long. You want to hear the story? The funny story about not being wrong for long? Who wants to hear that story? It's only 30 seconds. So my wife drives and gets lost a lot, even with the GPS, all right? I tell her the hood ornament should be a finger and tell you which way to go, right, left. So she'll joke and get mad. Well, one day I'm driving and I turn right, and I, about a block later, have to make a U-turn. I took the wrong turn. And she says, see, even you make a mistake, go the wrong way. I says, honey, I did, but I knew I was wrong in a block. You would have ran into Lake Michigan before you knew you were wrong. She told me gave me a compound name that starts with a ASS and ends in you know what? And we left. So you could be wrong. You don't want to be wrong for long. The guy that is telling you about being short bonds here, and he's still short bonds here and here, he's hoping. He's not trading. Skills turn to hope at that point. But if you could recognize, especially when these markets are even more opposite, bonds and stocks are going to relate tighter when there's fear in the market. You don't have to trade. In fact, I don't care if you trade bonds. You got to watch them. If you're trading the S&Ps, if you're trading any stock indexes, any stocks. So the point is that you see the consolidation box in here, and you see the top of the box in here. You see it in here. Now, it walks up. At the same time, it comes down. And I think in this instance, there was, and I'm not sure though, a little lead in the ES to the downside to get people long the bonds, or if you're short the ES, if you get short the ES, the confidence to stay short and to see that this move has more legs to it is the continuation up in bonds. You know, when people say, and this is, I think, a common pain point, what I said earlier, letting your winners run. Psychologically, you're not going to want to let your winners run because you're not right until you get out. The only thing that's going to allow you to let your winners run is something like this, where you stay short the ES because you see the bonds are going up. As soon as the bonds start going sideways, then you get out of your ES trade. Make sense? So to that question, how can I stay in the trades longer and stop having such small winners? Do your correlations confirm your position? You know, think about what I just said. That's simple and basic. That's one of the first lines I've said in front of all these webinars is I want to make what's basic to me basic to you, because guess what? It's not basic to the rest of the market, and it won't never be. The right basic stuff in trading is not basic to the rest of the world. And so just think of what I just told you. Common problem is How do I stay in trades longer? I let my winners run, overlap correlations, knowing the right correlation stocks and bonds, knowing that there's a geopolitical event that's driving them and making this tighter, and then being able to get short out of a consolidation box and stay short in that consolidation box because the bonds were continuing to drive higher up in here. So there was more legs to this downside. So you don't get out here and get picked off. I'll give you an example of just, I mean, verbally this working when we were in a prop firm. I mean, it would happen a lot. One guy would be like, he was watching the 30-year cash market and a guy was long bonds. He said, stay in it, Marty. He goes, cash is still rallying. They're still taking cash. They're still buying it. Stay in it, stay in it, stay in it. He probably made him an extra point, another 30 ticks on that trade because he just kept an eye on the cash for him. So again, confidence is the only thing that's going to keep you into trades because fear will get you out of them. Winners. Fear will get you out of winning trades and cut them short. You want to be objective. How do you be objective when you're emotional and you want to take the money, take the money, take the money? Bonds are not telling you to get out. Now, there are moments where the bonds don't correlate as tight because it's not fear in the market. But when there is fear, you know to correlate them. And in your right community, you'll be able to do that. It also keeps you from buying maybe some support that's going to get taken out. Keep your hand off the mouse. I often say saving money is like making money, especially in this business. When you could avoid taking a losing trade, you are now doing the opposite of what most retail traders do. They avoid the winning trades. If you can get yourself into a position to disqualify the eventual losing trade, saving money is like making money. And then you look at this, you got this continuation that happens again in the bonds. Look at this in the upper right in this red chart. They probably led the S&Ps down. This is overnight, so I wasn't trading it. So this, if you look at here, up here in the red, you see it drive up quick in there. Look where the S&Ps are. Do you want to get long or short here in the S&Ps? I don't know if you want to get short, but you better not be getting long if I'm reviewing it. Number one, because it's at the bottom of a potential box and there's sell stops below and the damn bonds just took up. And so the fact that it drives lower, eventually lower, lulls a lot of people to sleep, but it's one directional. With this continuation up here, now you're using objectivity, making your decisions instead of your emotions. So it came out of this box because of this rally. And in this case, the bonds led it. Upside bonds, weakness in the S&Ps. All right. Now, I use dome next to dome next to dome to find real-time upticks, downticks. I know in the chart, for instance, when a box is setting up, I could reference it and see it really quick. That's why the first webinar of this series was, how your eyes should fixate on a chart. So right away, I see this box is forming or it's forming. I can anticipate a drive up. I can anticipate this box, or I know this box is forming and maybe a drive lower. Now you're in a position to be on the right side and stay off the wrong side in a moment of reference. So now you become someone who's efficient and understands what's going on and could articulate that and think out loud is what essentially a good room is about. I'll kind of wrap this webinar up and I'll answer you guys' questions, but I'll wrap this up with another way to do this is are these dials that I had built on Sierra. And this particular page, what I do is makes it easier for me to see these upticks and downticks. Now, they're not moving around right now because it's a Saturday, but this, I've got them color coded. So if you look at this column, these are equities. This column are bonds. This column are metals. This column is energy. This column is 30 minutes because you could change the time frame of the equities. This guy right in here, each color dial or needle, Russell, Dow, NASDAQ, S&P, each color needle is a different market. So it's essentially taking these four and putting them on one dial. You see that? going to start storming here, so I don't want the internet to go out. I don't think it will. So don't ask me too much about these dials because I don't want to get too much into software and selling add-ons and stuff like that because that's not my forte. I'm trying to work through one issue I had with one of them, but these are a better way to see the same thing. And so when I'm comparing all these markets here, is there a needle that's to the left, which means it's weak. When they go clockwise, it's strong, and they go counterclockwise, it's weak. It's intuitive to read on the dial. The reason why I thought dials was the best way to compare and contrast markets. First of all, I've been a market relationship guy since I started. But secondly, everything you look that's important is in a dial, right? The dashboard in the cars we drive, and an instrument panel in the planes pilots fly. It must be intuitive. There must be some psychological attachment, correct? And so that's why I thought dials were good. And I know there's other people that have different dials. I didn't reinvent the wheel, no pun intended. I just made them simple. I just want to see it track price. I also have it where it tracks the delta, where you could have one needle is the delta and the other needle is the price. That's this guy right in here. Let me blow it up. Ooh, that's price and this is delta. So if the delta, it shows absorption and stuff. But I don't want to get too cute. I just keep everything simple. So you can have a page to see when you get one of these things to spin and you're looking to get long, maybe that's your kick in the ass moment to get you long. The ES, when you see these two spin, or you see these two spin counterclockwise and the S&P doesn't rally, right? Now, all of a sudden, you're putting yourself in a position to, understand strength and weakness. Man, it's getting dark here. This dial makes it easier just to condense everything. There's no doubt. And that's what I'll do for all these columns. It's all about saving screen space and being most efficient in my reference. So you look at this is a 30-minute column. I could tell you that the Russell's the weakest over the last 30 minutes, but not by much. This guy's the strongest, the ES, the Russell's the weakest, but not by much because they're all pointing the same way. If this webinar ends abruptly, it'll be because these storms have come in. But let me get to some questions. Just know if you get disconnected, it's because these storms came in, and if you never hear from me again, I got blown away. All right, let me ask or answer a couple questions you guys put out there. Let me shut this door. Hold on a second. All right, almost got blown away. I'm back. So let's go into Q&A here. If you got questions, pop them in. Let me go back over some other questions. So Joe asks, starting with market profile. Let me go through this. If you don't mind, I'm going to read your whole question because I think it's relevant to a lot of other people. If even people don't have this question, Joe. So Joe's starting with market profile. If I'm out of breath because I had to shut a couple windows. I'm starting with market profile, so a better idea of direction, which is good, and I agree that's what profile is good with. Seems to be, he says, underfunded, so he's trading the micro. That's awesome. I think that's a great decision. But to trade a micro, I need to hold trades longer to get good risk reward and better money. Not good. I'll explain that in a second. The thing is, I like to scalp. Man, the micro is frustrating in regards to scalping because fees and commissions. Yes, I would agree to that. If I was scalping the ES, he says, then I'd have no problem getting out of a trade for a few ticks, and the problem is risk reward. All right, so here's the thing. The market doesn't care about what's in your account. So it's never going to be conducive to the money you have in your account to give you a tick value that's better. So your problem is not always solvable. Just throw more money into it, but you can't try to put a square peg in a circular open, because that's what you try to do if you're trying to do something in an underfunded account. What you have to understand, and this is a whole another webinar I could do, is the micro is the best thing that the CME has done in the last 20 years. It's allowed people to have skin in the game to trade like absolute crap and only lose $20 or $50 instead of $500. All right. But you can't change your style because of the tick value. It's not big enough. So I got to hold on to trades longer. You have to hold on to trades based on your skill as to what's going to happen next. And that's what the market's giving you, not based on what your monetary goals are. And so many people have monetary goals that are unrealistic. So then they try to push a strategy to a goal that's unrealistic. Not going to happen. It's like a guy thinking he's going to make $1 million a year as a ditch digger. It's not going to happen. You got to get closer to what you need to do to make $1 million and pick an industry that pays that. And so this is a great question, because a lot of people fall victim to not just maybe being underfunded, but the fact that they try to take what the market's never going to give them. So yes, from a commission standpoint, the ES would be much more applicable to what you've been doing because of the ratio tick value to commission. But if you're underfunded, you're underfunded. What I can tell you is look at a different market. But when people try to make money in the micro, to me, that's not what it's for. Whether the CME has their goals on it, to me, the micro contracts is to practice with skin in the game so you don't worry about the money. Let me give you a quick story about that. Someone who was trading the ES he came to me, started trading. I said, don't trade the ES anymore, trade the micro. And it turned him around, because he said he lost $50, which is 50 ticks roughly. And it would have been over $600 roughly in the ES. It was only $50 in the micro. He says, but because it was only $50, I went back to see what I did wrong, found it, and then had 6 green days after that. He says, if it was the $600 in the ES, I would have never got that, energy to go back to see what I did wrong. I would have lost more the next day, or have taken a week off. So he would have done less work, solved no problem, and lost more money. So the micro is to practice, and don't worry about making money in the micro. Worry about practicing. And that's where you got to be. And then you could think you're underfunded, and you're not, because you're doing the right things to build your account up. So the whole value to these webinars, to my course, to my program, is to find better locations. And you will find them with them in the micro or the E-minis. But I also want to adjust your goals to be appropriate, or no matter what system or strategy or education you invest in, it's not going to matter. Omar, I think I answered your question. Let me know if I didn't. The benchmarks I look at: highs, low, support resistance, my support resistance, and then also consolidation boxes. Adrian, good question. What is a good point and figure configuration for the 30-year? Depends on the speed in which it's going. The faster a market goes, the higher the number. It's a rule of thumb, meaning the more volatile, the bigger the ranges of a market, the higher the number. So 2 is the one I showed you, 2 or 3, depending on how the market's moving. But rule of thumb for markets: bigger range, bigger PNF number. Good question. Could you use the dials to gauge a trend? Yeah, because you could also look at, Mike, when you have the dial, you could set it on a daily, and you could see that it's strong to the far right, but maybe some others are weakening up on their dailies. And you could see that the trend might not be stopping on the highs, let's say, in the ES, but it is in the other markets. So it keeps you aware of it, that the top might be in. Gianni, yes, this webinar is being recorded. Go to Edge Trading Group, search on YouTube to find the recordings of this one and the other two in this series that I've done. So Omar, with the dials, yes, you're visualizing upticks and downticks over a period of time. Exactly right. So over the last, in this column, right in here, let's just look at this top left one. The last 5 minutes, this was the range. Each hash mark is a tick. All right. If you jump over here, this is the range over the last 30 minutes. And you could set your time to be whatever. So it's a running 5 minutes. And it adjusts accordingly. So when it's on the far right, that means it's at the highest it's been over the last 5 minutes. Joe, I just sent you a chat message. Let me put that in there. A couple of people asked for it instead of just saying it. I'll put it in there. If you have any questions, Anthony at Edge Trading Group.com. Anthony at edgetradinggroup.com. I just put it in there in the group chat. Those watching it on video only in the future, you know how to get back through to me. I don't want to leave these dials up and think people, well, where do I get them? They're possibly going to be available. But like I said, I don't want to get too deep into the software into things because it's a whole nother layer of support and everything else. And that's why I've been testing it for a while. I really want to be bug free. It's not my strength. Carl M, that's for a reason. So any other questions you guys might have? Go to YouTube, search Edge Trading Group to find my channel and these webinars. Give me a little bit for me to post this guy. First two are up. The next two are tomorrow night, 7 p.m. Central, and Monday morning at 11 Central. Although I don't like to move Mondays, but I think we might get a better attendance for Monday night. Oh, no, I want to talk about that now, Jim. Thanks for reminding me. Let me reread the question, though. Let me scroll back up. Because I talked about earlier about the prop firm and why did they hire me? Let me scroll back down. They liked my hair. No. When I came, I didn't know anything about it. Let me just back up. When I was trading on the floor, I was in the business for like 4 years. I didn't even know what a proprietary firm is. And I don't think most people even listening to this webinar know exactly what a real prop firm is. I didn't know because I didn't know what one was. And I was kind of in the business in late 99, early 2000. When I found out what a prop firm was, the guy who worked there was a risk manager. He didn't trade, he was a risk manager. He said, come on, I'll show you what we do. It was never like an interview, and it turned into one. But the owner wasn't there when he was showing me around, and that's when I asked, hey, where is everybody? It was like noon. Everybody was gone. He says, hey, we're done about 10:30, 11. And I thought, well, you guys get here at 1 a.m? No, we're done at, we start about 6 or 7 guys roll in here. I'm like, wow. So that made me think, wow, this might be a good place to work. And I'll just back up and tell the story. But he says, come back in next week, and the owner's here, and we do an interview. So when I went home, I asked my dad, what do you think? He says, go there before 10:30 and see the cars in the parking lot. Nice cars. They're making money. So I got there before 10:30 and waited. I seen Mercedes and BMW. So I knew I was probably going to take the job. They offered it. In the interview, the owner of the prop firm was an ex-pit trader. So my answers in my dialogue was just naturally, I knew the business. But here's the last thing he said. He goes, I got one more question for you. So right away, I'm thinking, well, it's going to be an important one. He goes, what makes you think you could make money at this? And I just didn't think about it. My knee jerk answer was because I'm putting myself around guys that are doing it. And he says, good answer. He says, I don't need to check his references. He looked at the risk manager. You got the position if you'd like it. He says, but let me add something. It's not just about putting yourself around people making money, but also around people who are trying to make money. He says that combination creates a higher level of success. If you're just around people making money, you might get jealous. You might get, your confidence might take a beating. He says, but when you're also around people that are trying to make money, you got different levels of experience. You become a little bit of a leader among that group, and then you still see you're aspiring to people who are making money. He goes, but it's both. He says, but that's the answer I was looking for. And I'll be honest to you, I just knee jerk made that answer up and happened to get it right. But I think it came from my dad saying, hey, look at the cars in the parking lot. If they're nice cars, they're making money. And that's where the answer came from. You know, I knew I could do it, but being around people doing it, and then what he said, being around people trying to do it, was the keystone to the whole, bedrock foundation to give yourself a better chance. That's why this Edge Trading Group and this website and these products I have, the only mission statement is, can't promise you'll make money, but I can't say you have your best chance at it. That's it. Or a better chance at it. That's all you could try to look for is, how do I give myself the best chance to do this? How do I know I overturned every stone? You know, if you're still looking for the blinking red light or green light, continue on that path. I discourage it, but continue on that path until you come to the realization that there's not going to be a red light, green light. And if there is one that works like crazy, why is the guy going to sell it to me? There's just probability stuff. And that probability stuff has to have the question why answered. So I got hired April of 2000. So this April will be my 20th year in the business trading electronically. And I started making money within the first month. And the day I knew I was going to make it was 222, not the date, 222 ticks I made, 222. And not that it was $2,200, it was $10 a tick. It was that it was with one lots. I traded really well with one lots and made 222 ticks. And that's when I increased to 2 lots and 3 lots, and the rest became easier. And that was within the first couple months. And that's when I knew I went from failing, ready to quit in the pit, to off to the races, looking for an engagement ring, to the woman who kept me in the business because I was ready to quit, go back to doing electrical work when I was on the floor. She said, well, stick with it. We were just dating. She says, I could support you, or don't worry about money. We were in our early 20s. And so, by the fall of 2000, late 2000, I was making really good money. And what I try to stress on people today is, no matter how stellar the education you might get, you're supposed to lose money first. You're supposed to break even next, and then you get around to making money. If you could keep your losses small early on, and if you could keep getting break even sooner, then you're on the way to maybe turning the corner, and then building upon that from there. But people who want the quick fix and to start making money in a week or two, they're going to have to get over that unrealistic goal first and then move forward. I know the great marketers out there would try to stand in front of my house and my car to sell you a product. I want people that are realistic to, the right stuff and to be around, because I'm not building I'm not just like selling a room or anything. I'm continuing to build a community. So I want good people to be around good people. And that becomes pretty powerful. In the last few years, we've done that. In fact, a number of guys in our team room are here today. Yeah, and if I never got in this business, I'd have never met Carl. I would have quit. I wouldn't have been here today. So that's the story of my transition from the floor to the screen and the prop firm. And again, you can do a whole nother webinar on real prop firms, because I know a lot of people do a Google search and they find a prop firm or what claims to be a prop firm, and they're really not. So I could do a webinar on making sure you know what a real prop firm. That's what I've recreated in the team room, is guys that talk like traders, period. If you don't talk like a trader, then you're not a trader. You got to talk like a trader and have that industry speak. It's very, very important. And that's why these 5 webinars is a checklist I want you to become proficient at. If you're not proficient at these 5 things, go become a plumber. And I say that in as kindly as I can. Any other questions? If not, I'll let you guys enjoy your weekend. Tomorrow night, 7 Central, we're going to do this again. Try to be there. It'll be after football. We have football coming on right now. Topic for tomorrow, Mike, is going to be efficient trade review. All right, guys, you have a great day as well. We'll see everybody hopefully tomorrow night. Look for this recording in a few hours, at the latest tonight on YouTube, if you want to watch it again. Sheriff Tom, thank you. That's the other great thing about this community that's been built, is there's people from all walks of life, and police and doctors and lawyers and pilots and engineers and electricians and every walk of life. And the common denominator among the people that come to me, they've been successful at those other things. So you're always around people that know what it takes to be and stay successful. That's what's cool. I learned a lot from the many different walks of life. Sheriff Tom is here, always around. Taught me how to get out of a ticket. All right, guys, we'll see you tomorrow night. If you're watching this in the future on YouTube, webinar 4 is probably posted somewhere else on the channel. Be safe, guys. We'll see you then.